Hello and welcome. My name is Enrique Levine, co-founder and VP of Product at Zintro. Zintro is a global online marketplace that helps connect companies with highly specialized consultants and other expertise providers for projects that range from one-hour phone consults to multi-month on-site engagements and even full-time jobs in over 10,000 areas of expertise. Today's webinar, Positioning Your Company for Debt Financing, How You Can Make Your Business Attractive to Commercial Lenders, will be presented by Gary Honig, President of Creative Capital Associates, Incorporated. Mr. Honig has been involved with the factoring industry since the early 1990s, where he became a CCA Business Development Officer for the Mid-Atlantic. In 1997, he spearheaded a takeover of the company and reformed it as a Maryland corporation. Mr. Honig has been at the helm since and oversees all aspects of running CCA, which now provides invoice factoring nationwide. He is also active with the IFA, the Factoring Industry Association. If you would like to ask Gary any specific questions throughout the webinar, feel free to use the questions section of your GoToWebinar control panel. Click on the little orange arrow on the top right corner of your screen and you'll be able to see the questions section. Please feel free to ask anything throughout the webinar. Gary will be responding to questions at the end of this presentation, so stay tuned. We will also be providing Gary's contact information at the end of this webinar for follow-ups. Without further ado, I'd like to turn it over to our presenter, Gary Honig.
Thank you, Enrique. I really appreciate the introduction. I want to thank everybody for attending this seminar today, this webinar. The mission of this webinar is to provide you with information about how lenders look at small businesses with the idea of providing capital, securing loans, etc., and how small businesses can proactively treat this process of getting financing so they can use it to their advantage. I'd like to just briefly touch on the difference between debt financing and equity financing. Everybody is probably aware of equity financing, venture capital, angels. That's when you have an idea or a product or a company that has some sort of value and a group that might be interested in that value and becoming a partner in the growth of that company. Debt financing is where you have some sort of asset where you can borrow against it. Typically, real estate and equipment and inventory and accounts receivable are used as assets, things of value that a lender can liquidate in case of non-payment of the loan. So the difference between equity and debt would be one becomes a partner and decides whether or not they feel the risk of the upside is worth the potential of the downside, which is essentially losing their investment. Banks don't like to look at that equation. They don't take on risk with the possibility of losing money. At least they don't go into the relationship with the idea of losing money. They want to mitigate their risk by having collateral available so that they can always be on the upside of getting their money back. So what are banks looking for? What are they doing to look at your business with the idea that they might potentially feel safe in lending you money? And that's always going to be the underwriting issue, is the safety of the loan, whether they're going to get their money back. And so what are some of the things that you can do as a small business to mitigate their risk and show them that you're going to be a qualified borrower? So a lot of the things that I'm going to discuss right now have to do with how you go about running your company and some of the attention you can pay to certain aspects that a lender is going to look at, where a small business is really kind of just concentrating on primarily sales and marketing to get and promote and grow their company. So there's some underlying issues that you can do side by side and, again, be attractive to the lenders. So one of the first things that a lender will look at is this word concentration. Some lenders will actually have certain terms and conditions regarding concentration where they won't allow your income to be coming from less than a certain percentage of various different customers. So in other words, if you have one customer, you're 100% concentration. If you have 5 customers, you're 25%, 20% concentration, sorry. And so that's how they look at it. They'll go, well, we're not going to lend on any particular part of your business that is too heavily concentrated. And the obvious reason is if you lose your customer, then your overall business and revenue will suffer. And they're always trying to mitigate the risk, and you mitigate the risk by having many customers evenly spread out throughout your business. So if you're paying attention to, okay, I want to borrow money down the road, then you're also paying attention to not having heavily concentration in your revenue. And so that's the first thing that you can look for when you're deciding that I want to become attractive to a lender. The next is creditworthiness. And the idea behind this is, what are you doing in terms of deciding whether or not to extend credit to your customers? In other words, if you provide a product or service to your customer and you extend terms, typically 30-day terms, you essentially are becoming a bank yourself. You're lending money to your customer with the hopes of getting repaid. And the concept here is, what are you doing to determine the creditworthiness of that customer? If you do a job and it's a $50,000 job, you're extending $50,000 credit to your customer. What are you doing to determine whether or not that customer is creditworthy for $50,000? They might not be able to get a $5,000 loan from a bank. So the activity that you're doing to oversee this creditworthiness is going to be really interesting to the lender. They want to know what kind of terms and conditions and credit management you have in place, so they know that you're not just finding sales and extending credit without any kind of backdrop to how you extend credit to your customers. And so the process of how you do your due diligence and extend credit is going to be very noteworthy to your lender, and they want to see you have a process in place. Being able to do bookkeeping in-house is really important to a business. It not only is a snapshot of the financial condition of your company at any given moment, It also provides insight into how you know whether or not you're profitable, whether your profit margins are properly assessed, whether you know which parts of your business are profitable, um, and have designs on how and where your money is being utilized in the best sense. So it's very important that whether you're using QuickBooks or other formats, it's important that you have this on a regular basis, that you can attend to it in a quick manner, that you know exactly where your business is going. And a further development, a modern development in all of this, is that there are actual facilities and lenders that can dial right into your QuickBooks on an ongoing basis and make instant determination on whether or not you can qualify for a particular loan. And some business owners might be obviously reluctant to have lenders being able to have access to their accounting on a regular basis, but this is a new development that you'll start seeing more and more of, where especially with an intermediary, they would be able to instantly qualify you for loans using your bookkeeping. And so the skill of bookkeeping and knowing how to properly assign your accounts is going to be critical to being attractive to a lender. Obviously, taxes is a very important issue. Delinquent taxes, for the most part, will make you unqualified for conventional lending, and so you want to make sure that your taxes are constantly up to date. One of the more prevalent tax issues is 941 payroll taxes, and so it's very critical to know that the payroll tax issue is really important to state and federal tax agencies, and this is really meant to be a message to people that use 1099 independent contractors. The different agencies are paying very close attention to the use of 1099 independent contractors, and you should be really aware of what the actual limitations are using that classification. And it's important to always know where you stand with your taxes and being able to pay them on a timely fashion for obvious reasons. Adverse events do happen to businesses. It happens from time to time. It could happen with a past business, and it's very important in the initial stages of talking to a lender that any past adverse events you come clean on as quickly as possible, just to let them know what the situation was. I think that any lender that knows the story right up front can deal with that information and decide whether or not it's going to be an issue. Lenders are very reluctant to find out about this stuff by themselves, and they usually can. And so this slide is basically just saying, if you have any type of adverse event in your past history, to quickly make it transparent to anybody that's paying particular attention to the process of going ahead and borrowing money. The application process with lenders. What I try to tell entrepreneurs is that you should have a kind of a loan package put together prior to going out and applying for funding. And this should be something that you have on a normal basis and update it regularly with current financials. That would be balance statements, income statements, accounts receivable aging, accounts payable aging, but then also to have things like copies of articles of incorporation, tax ID information, partnership agreements, various documentation that you shouldn't have to go and hunt for. You should have it all ready, especially in a digital form, so you can zip it up and send it to a lender. If you become, as I'm describing, attractive to a lender, then you'd want to send this loan package out to 2 or 3 lenders and get their bids on your business. And so this would be a way of being able to do that in a very expedient way. Also, it telegraphs to the potential lender that you understand this process of going out and borrowing money, and that you have predetermined, okay, I'm putting all my documentation together, rather than having to be asked, well, where is this, where is that document? If you show that you already know you're in the process of borrowing money and you have all your documents all together, it's a great way for the lender to understand, okay, this person understands the process, they're fully engaged in it, and that's a very positive step in this borrowing money process. When you get to the point where you have qualified for a loan and there are going to be contracts involved in terms of the loan documents, certainly you want them reviewed. You want to be able to understand them, but there are going to be written in very severe language, because when a lender is engaged with you in a relationship where you're borrowing money, they're always looking at the worst case scenario. And the issue I described to my clients is, I can't have a set of loan documents that are kind of very friendly sounding, and then if things go very badly, I've got to get another set of documents that have the onerous language I need to protect my capital. You have to walk in on the first day with the idea that these documents are going to cover any potential bad situation. And then just rest assured that as long as everything is going as planned, that nothing, they'll basically be sheets of paper in a drawer. At the terms and conditions of the loan are upheld, and everything is going fine, and there aren't any defaults, then they no longer are going to be an issue. But just to expect that contracts are going to have that type of language that protects the lender. This is probably one of the more important slides. Using the right tool for the right situation. So it's really important to understand what you're trying to achieve with the money you're borrowing. And if you're trying to acquire, let's say, a piece of equipment or a building or some large software facility or something that you need the money now, but the revenue from that purchase won't start filtering in until 6 months to a year later, over a period of 2 or 3 years. That would describe a term loan, a type of loan where you would get money up front and then pay essentially like a mortgage on that money, a monthly payment, which is significantly different than a line of credit. A line of credit being where you have an availability where you are extended credit, a credit limit, let's say $100,000, and you would have this line that is like a checkbook, and you are constantly writing checks against that line. The critical important aspect of a line of credit that a small business owner needs to be fully aware of is that they need to have the discipline to use that line of credit properly. And what I mean by that is that you are taking money out from the line, you're writing a check, you're paying a bill, but that is going to correlate with some sort of revenue coming in from the sale of something. And so that discipline to take money out from the line but then to put money back into the line on a regular basis is going to be critical to the success of using a line of credit. Too often a small business will take some money out, maybe put a little bit more back, take money out, take a little bit, and essentially what they're doing is they're chipping away at that line of credit. So over time they'll have a balance and liability on that line of credit that is built up over time, and when it comes to a point where they need more money, if they go to a different lending facility, they're going to need to pay off that old line that they've been using and chipping away at for the last couple of years. That's a very critical distinction and leaves a lot of small businesses in the lurch because they're not they don't have the availability to qualify for another loan unless they pay off this line that they've been using and not paying off on a regular basis. So that's a very important aspect of when you borrow money to use it properly. And I want to touch on this last point on this slide, the Uniform Commercial Code. Every small business owner should be aware of the Uniform Commercial Code, the UCC. The UCC has two components, two reasons for being. The first being the gatekeeper. It tells lenders that you've used your collateral for borrowing so that you cannot use the same collateral over and over to different lenders. The UCC is filed with the state agency, and all it is something that every lender can do a quick search to determine whether or not you've used certain business assets as collateral. That's the first reason you use it. The second reason is that in the case of any type of liquidation situation where you're filing for bankruptcy and a trustee of the court is liquidating the assets, the lender always wants to have a first position on those assets so that they get paid 100% on the dollar. And that's what being secured and having the UCC is all about from a lender standpoint. They want to know that they have rights to the assets that they lent against. What's important for small business owners to know is that whole how lenders look at the UCC. And so one frequent situation that I find is that a small business will get started up, they'll go to a bank, and they'll get essentially what's called a signature loan from the bank. And this is basically a loan to the company based on the strength of the personal FICO score and maybe some home equity, but essentially the company has nothing, and so the lender is not really lending anything on the company. But what the lender will do is file a UCC on the business assets, even though they're really lending on the strength of the personal credit of the business owner. And so business owners are unaware of this UCC. They're unaware that the UCC is about to be filed on their company, and it will prohibit them from going out and being able to borrow from another lender because the UCC is in place. And the UCC is not necessarily it's a negotiable instrument, and that means that if you're talking to a bank and you're getting a signature loan, you can say, you know, I'll get a loan with your bank, but I don't want you to file a UCC because my company has no assets and you're either lending against my credit, you know, you're not lending against any business assets because I don't have any. If you find one bank that says, okay, yes, we'll not file a UCC, and you go with them and you start building your business, and 2 or 3 years later you do want to go after some more money, the new lender would be able to go, great, I can lend you money because this UCC is not in place, and so now you have your signature line of credit, which you can keep, and you'll have new access to capital. And so that's a kind of a long-winded way of explaining that the UCC is really important to know about in terms of what your position is at any given moment, who has filed any UCC against you. It also works in terms of whether you're trying to borrow working capital and you ask the lender to not file on your equipment. And so you could potentially have a UCC filed on, let's say, accounts receivable, but not filed on your equipment. You could potentially go out and borrow against, if you have a large facility with a lot of equipment, you could borrow money against that equipment because the UCC is not covered on the previous lender. So those types of scenarios work themselves out, and it's just you need to be aware of that potential. Of course, lenders are looking at the big picture and they want to get a sense of who they're dealing with in terms of lending money, and so having a good executive summary of who's involved and what their background is and their history in a particular industry is going to be really important because it was much more prevalent in the old days when a banker would be in the same town as their borrower, and they would know each other from even social settings, and they would understand that they're dealing with an upstanding citizen. Well, those days are kind of long gone, and so companies are much more global. Banks are obviously working on massive scale, and so anything you can do to let the lender know that your company is been cited as running itself in a profitable and upstanding manner is going to be helpful. Things like Better Business Bureau and good Dun & Bradstreet ratings and things of that nature are always going to be important to let the lender know that these are good guys and it's probably a safe bet. One of the things, like any interaction with anything professionally, if you get a phone message, return the message. If you are asked for documents, get the documents as quickly as possible. It's just a matter of being professional. It's being attendant to the needs of whoever it is that you're dealing with. And so you'd be surprised how many companies come to us looking for funding, and we can just never even get them back on the phone. They won't answer emails or anything else. And so it surprises me from time to time that people will operate as a company but don't really take the time to show interested parties, especially when they instigate the connection, that it's just important to always handle your company as if it's always on the front lines of communication. And that concludes my 10 points on being attractive to lenders and positioning your company for debt financing.
On behalf of Zintro and our over 170,000 members, thank you so much for sharing your insights. This closes today's presentation. Have a great day.